When you think of the greatest investors in history, Warren Buffett's name is pretty much always at the top of the list. But his entire massive philosophy seems to boil down to one deceptively simple idea. But here's the catch. How can the master of investing follow a rule that he himself has broken? So let's unpack this. Let's decode what the Oracle of Omaha really means. And this right here, this is the cornerstone of his entire worldview. It's blunt, it's powerful, and it really is the foundation of his whole approach. Before you even think about making money, the number one priority is protecting what you have. Sounds easy enough, right? But, okay, here's the thing, the big paradox. Buffett himself has made investments that have lost money, a lot of them over his career. So if the guy who made the rule has broken it himself, what on earth is he really trying to tell us? All right, so to really get what he means, we've got to look at one of his most famous investments, which, funny enough, he considers one of his biggest screw-ups. It's pretty ironic, right? The company that basically made him who he is today, Berkshire Hathaway, actually started as an investment he wishes he could take back. He bought into this failing textile mill partly out of anger, an emotional decision, and that put him at huge risk of the one thing he warns against, a permanent loss of capital. And that right there proved the rule isn't about dodging every little dip in price. No, it's about avoiding a very specific kind of loss. Okay, so if never lose money doesn't mean your portfolio never goes down, what does it mean? What's this big, scary loss he's really talking about? This is where we get to the absolute heart of his philosophy. So check this out. This is the crucial distinction he learned from his mentor, the great Ben Graham. There's a world of difference between a temporary price fluctuation, the daily mood swings of Mr. Market, and the permanent impairment of your capital. See, a stock price dropping? That's just market noise. That's Mr. Market having a bad day. But the business itself, the actual company failing and going to zero? That's the real disaster. That's the permanent loss he's warning us about. So what this really boils down to is that the real boogeyman isn't a market crash. Nope. The true enemies are inside your own head. It's making decisions based on fear or greed, it's gambling on short-term fads, and it's getting swept up in whatever hype is dominating the news. Those are the things that lead to that permanent loss. And look, this isn't just some philosophical mumbo-jumbo. The numbers are absolutely brutal. Something like a staggering 99% of day traders, the folks trying to play those short-term wiggles, consistently lose money. Buffett's entire philosophy is basically designed to make sure you don't become part of that statistic. So, how do you avoid becoming a statistic? How do you avoid that permanent, soul-crushing loss? Well, it starts with a complete shift in how you see things. You got to stop thinking like you're trading stocks and start thinking like you're buying actual businesses. You see, for Buffett, a stock isn't just some letters on a screen, right? It's not a lottery ticket. It's a tiny piece of ownership in a real, breathing business. And if that business does well, if it's profitable and well-run, its value will, sooner or later, show up in its stock price. You focus on the health of the business, not the daily chaos of the market. And believe me, when he says long-term, he means it. He takes it to the absolute extreme. Think about it like this. Would you buy a stock today if you knew the market was going to shut down for the next 5 years? If the answer is no, you're probably just gambling. His perfect holding period? Forever, as long as the company keeps being a wonderful business. Okay, great. So you're buying a business, you're in it for the long haul. But how do you make sure you don't pay too much and end up breaking rule number 1 anyway? Well, that brings us to the next massive piece of his philosophy. These 3 words, they are the absolute bedrock of his entire strategy. The margin of safety, that's your shield. It's what protects your capital and gives you a buffer when, stuff inevitably goes wrong. So what exactly is it? Well, put simply, it's the discount. It's the gap between what a company is actually worth, its intrinsic value, and the price tag the market has slapped on it. Analysts try to figure out that true value by doing things like forecasting all the cash it'll make in the future, or just adding up all its assets. The bigger that gap, the safer you are. Let me give you a super simple example to make this concrete. If you've done your homework and figured out a business is truly worth $100 a share, but the panicky market is selling it for $50, you've got a 50% margin of safety. This right here is Buffett's whole game. It's about finding a way to buy a dollar bill for 50 cents. And this quote just nails it. price is the chaotic, emotional storm you see on the news every day. Value? Value is the deep-rooted, durable business that weathers that storm. A real investor learns to ignore the storm and focus on the strength of the roots. All right, we're almost there. The final piece of the puzzle. And this one isn't about fancy formulas or complex spreadsheets. This one is all about you. Buffett's big piece of advice here is to be brutally, unflinchingly honest with yourself about what you know and, more importantly, what you don't know. You don't have to understand biotech and software and energy. You just have to deeply understand the few businesses you choose to own. If you stick inside that circle of competence, you've built one of your best defenses against making a catastrophic mistake. And man, this is such a powerful way to think about risk, isn't it? For him, risk isn't the market bouncing up and down. Risk is you not knowing what you're doing. The real danger is plowing your hard-earned money into something you don't really understand. Knowledge, plain and simple, is the ultimate tool to manage that risk. So, what does it really take to pull this off? Well, according to Buffett, it all boils down to a few key personal traits. First, you need an independent mind to do your own thinking instead of just following the herd. Second, you need rock-solid emotional stability to stay calm or even get greedy when everyone else is panicking. And finally, you have to understand human behavior because, as he said, the stock market is just a device for transferring money from the impatient to the patient. So, when you put all these pieces together, you start to see that never lose money isn't some literal impossible command. It's an entire philosophy, a whole mindset. It means you avoid permanent loss by buying wonderful businesses you understand at a price that gives you a huge margin of safety, and then having the discipline to hold on and let them work for you. And that really leaves us with one final crucial question. Buffett has always said that the right temperament is way more important than having a genius-level IQ. So you got to ask yourself, honestly, when it comes to your money, is your temperament your greatest asset, or is it your biggest liability?